Good afternoon and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from the Nasdaq PHLX options trading floor. Joining me for this segment, we have Sean Clark. He's the CIO of Clark Capital Management. Great to have you back with me.
Hi, it's good to be here.
What
Thank you.
What a difference a year makes.
You got that right.
Very different conversation than what we had December of last year to where we are now.
What conversation will we have next year?
Oh
this
my gosh.
time?
Well,
hopefully a better one.
If Q4 is any indication of what 2019 is going to look like, we're in for a pretty wild ride. I mean, just look at the swings in the market today. We were up 33
points.
handles at one point.
Yeah.
So how do you approach 2019?
Gosh, so hopefully 2019 will be a lot different than the last 3 or 4 months of this year. As we move into 2019, we're a little bit more optimistic. Investor sentiment is turned pretty sour and pretty pessimistic. Valuations have come in. Earnings growth, while it's slowing from the 26% pace that we've had this year, we expect about 7 to 9% earnings growth in 2019. It's a far cry from where we are right now.
But it's not bad.
It's not bad. Still, it supports the market moving higher, or at least stabilizing, and we get a few lucky breaks here and there. The economy's still strong. We expect the economy to grow by about 2.5% next year. No recession on the horizon, probably not until the end of 2020, maybe even 2021. That backdrop is not all that terrible for stocks.
Well, you think fixed income is also going to be a key theme for 2019. I would imagine, based on what you said, if you don't see recession until 2020, 2021, you're going to want to start to think about these kinds of assets.
You know what's interesting? So before this market volatility that we've had over the past quarter or so, the number one question we got as a firm was, what are you guys going to do? How are you managing fixed income in a rising interest rate environment? And we were out there really defending fixed income as an asset class. Stability, cash flow, diversification, offset equity market volatility, all of that stuff. We haven't had one single question about fixed income since the equity market volatility happened. Why is that? People realize the benefit of fixed income in an overall more diversified portfolio. So as we move into 2019, what's happening with interest rates? The 10-year Treasury has come down to about 2.8%, whereas the 2-year, 2.65.
Right.
It's about a 15 basis point difference between the 2-year Treasury and the 10-year. Right now, short-term cash and cash equivalents, let's say 18 months and below in duration with a little bit of credit risk, is really attractive. We're generating about 300 to 325 basis points in portfolios. Now, you start comparing that to the dividend yield for stocks. The S&P is about just a little bit more than 2%. Bonds are really attractive in this environment right now. I
mean, if it's at 2%, there's a reason why yields creep higher when they're based on stocks, because that means something's going down. So that definitely makes sense there. What are some of the market headwinds going to 2019? Because there are a number of outliers out there, and we're seeing that clearly reflected in the action this week. Incredibly choppy. It is not normal to get the swings that we've seen throughout the week.
Right. I think as we go into next year, we're going to face a lot of the same headwinds that we faced this year.
Right.
So Europe's a disaster, right? You have Deutsche Bank that's a mess right now. Brexit is a constant theme that keeps rearing its ugly head. Geopolitical risk with riots in France and protests. The Italians with a budget standoff with the EU. So that's Europe. Then China with a trade tension. That's not going away anytime soon. Even if there is a potential deal that's to be had sometime in the first quarter, maybe even a little bit later next year, the tension's still going to be there, because any deal that happens with China is going to be goods related. The real issue is the technology transfer from the US over to China. That's not going away. Interest rates, the Fed has been an issue. This week in particular, with the messaging that came out of the Fed, has really roiled the markets. We don't think the Fed will continue to hike interest rates to the same degree that they did this year or next year. In fact, we think the Fed will actually disappoint in the number of hikes. The Fed now, they adjusted lower. They said they're going to hike 2 times. We'd be surprised if they hike 2 times. We're looking at maybe 1 hike next year. If the Fed would get their messaging correct about that, maybe the market could stabilize and gain its footing.
Yeah, I mean, but where are we going to get global leadership from? It usually has been from the U.S., but even just look at the news cycle this week, regardless of what your political leanings are, it's erratic, right? And it's we don't have a chief of staff, we don't have a secretary of defense. There is going to be clearly a vacuum in the Middle East, and we're dictating policy tweet after tweet. It's again, regardless if you agree with someone or not,
We live in interesting times.
I
right?
understand that, and I realize, the erratic market action that we've seen this week, I think it is more than interest rates. And I feel like there's a lot of holes right now that can't be plugged up until we get some leadership somewhere.
Right, well, that suggests that maybe this correction, and listen, we're in a correction in the context of a long-term, what we think long-term secular bull market. Corrections happen, volatility is a thing in the markets. We came into this year saying, expect two things. Expect the return of normal market corrections and an uptick in volatility.
Right.
We've got both. You're right, there's a vacuum of leadership. The political tension is bigger here in the US than any other time
Right.
I can remember. But the economy is still going to grow. That should help support the markets. However, if we look overseas, we see real opportunity overseas.
Right.
Emerging markets, right? If we just look at what's happened here in the US or just this quarter and compare the relative strength of emerging markets to the US, emerging markets have gotten some really good relative, they're not up, but they're not down 15%.
Right.
Over the past 4 weeks or so, they may be down 2 or 3%. Not that bad. We're starting to see strength emerge overseas, and next year, if the Fed's not hiking interest rates to the same degree, the dollar probably isn't going to have the same rate of ascent in commodities. Oil's been a disaster. So if oil stabilizes and moves higher, all of that should benefit emerging markets. So we would look for real strength coming from emerging markets, especially if the US market starts to participate on the upside. We would expect emerging markets to lead and outperform next year.
Right, so that's the key, is identifying the opportunity and the outperforming asset class sector region. All right, and let's wrap it up here. We touched on corporate earnings before in 2019, for 2019, not quite as high as we've seen in 17 or 18, but still 7 to 9% is not that bad. I take that return.
That's 7 to 9% corporate earnings growth historically has supported the market moving higher. Without a recession, that's what we should get. It'll be a disappointment, but I think what the market's doing right now, part of what the market's doing now, is adjusting to the reality that the earnings growth peak is behind us. Doesn't mean earnings are going to go down, it just means they're not going to grow as quickly as they have been. So investors need to reset their expectations. Valuations, stocks down, earnings still up. What's happened to valuations? Look at a forward 12-month price to earnings ratio. It's dropped from about 18.5 to 14 on the S&P 500. That's the lowest it's been since about 2013.
So if you're a value manager, you've got to be happy about that. And that narrative is going to come into play shortly too.
Yeah, so better valuations, investors are pessimistic, those seeds of pessimism have been replanted. That usually is what begins to spur a market rebound.
All right, well, let's hope so.
Yeah.
Thank you so much for joining us on the floor.
Thank you.
And thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Report.